quorum for the annual general meeting is a third, which is 33.3% of the issued shares. I confirm that a total number of 7,824 shareholders holding a total of 2,503,667,679 shares, representing 68.48% of the shareholding, are attending this electronic annual general meeting. I therefore confirm that we do have quorum for this meeting.
Having confirmed, I declare the meeting to be properly convened and duly constituted. I call upon the company secretary to read the highlights of the notice and agenda of convening this meeting.
Chairman, I confirm that the notice and agenda of the meeting, as outlined on pages 265 to 268 of the Integrated Annual Report, was published in the daily newspaper, the Daily Nation, and the Standard on the 4th June 2024. Additionally, the notice was published and is on the company's website until now. Chairman, we will have ordinary business and special business to conduct today, and Chairman, we will take the notice as read by the shareholders, having been circulated on time. Thank you, Chairman.
Ladies and gentlemen, we will now commence the formal business of today's meeting. Shareholders, the 2023 annual report and consolidated audited financial statements were made available to all shareholders through a publication in the local dailies, and the full report was made available on the company's website as indicated in the notice convening this meeting, which was published on the 4th of June 2024. Shareholders, my report to you for the year ended 31st December 2023 is contained in the integrated report on pages 23 to 24. I shall take the report as read. The integrated report remains accessible on the company's website. I encourage all shareholders to read the detailed statement for information. I will only give a few highlights of my statement. Ladies and gentlemen, the economic scene in the year 2023 was marked by uncertainty and instability. The emergence of conflicts, notably the Ukraine-Russian war and the Israeli-Palestine conflict, amidst the reopening of economies after the pandemic, presented complex challenges impacting efforts to economically bounce back due to geopolitical factors. These uncertainties caused disruptions to global supply chains and trade routes, and as a result, the global trade growth at 0.2% was the weakest performance outside of global recession in 50 years. The regions in which we operate continue to experience the impacts of the global realities, including marked interest rate hikes by regulators, currency depreciation, discernible escalation in the cost of living and inflation, coupled with increased concerns on debt sustainability. Despite all those challenges, I am delighted to note that Equity Group registered a significant revenue growth of 25% from Kenya shillings 145.9 billion to Kenya shillings 181.7 billion, and a profit after tax of Kenya shillings 43.7 billion as at 31st December 2023. This showcased the continued resilience and fortitude that define the group and their unwavering commitment to our stakeholders. Subsidiaries in the Democratic Republic of Congo, Rwanda, Tanzania, and Uganda increased their contribution to the overall revenues alongside our investment and insurance offerings. This underscores the pivotal role of diversification as a cornerstone of the group's enduring performance. In acknowledging the profound implications of the economic challenges, we recognize the ripple effects reverberating through to our stakeholders, and particularly our customers, who have had to bear the brunt of multiple impacts on their businesses and livelihoods. As a group, cognizant of the implications of these challenges to our customers, we consciously choose to proactively support our customers through relevant, affordable, and easily accessible services and products. We understand that behind every account or transaction is a unique individual, all organizations with specific requirements and goals. In line with the diversification strategy, Equity aims to not only leverage on the existing life assurance operations, but to also grow and expand its footprint in the insurance sector. Equity purposes to offer uniquely designed health insurance solutions anchored through the Equity Afya Network and other healthcare providers by tapping into our extensive non-digital and digital rails. The combination of life, general and medical insurance products will complement Equity Group's core banking operations and its African Recovery and Resilience Plan. This strategy aims to offer integrated financial services to both corporate and retail customers by availing insurance solutions at the point of sale or interaction, lowering customer acquisition costs and charging affordable premium rates. At a broader level, we continued stakeholder engagements with key partners as we sought to catalyze interest and involvement in the Africa Recovery and Resilience Plan. We also signed up to the Task Force on Nature-Related Financial Disclosures as an early adopter. Our social agent, the Equity Group Foundation, continues to provide support on environmental and social needs, with total funds raised as at 31st December 2023 being USD 649 million. The funds were utilized in supporting 60,009 scorers, training 517,247 micro, small and medium enterprises on entrepreneurship, training 2.4 million women and youth in financial education, planting 25.2 million trees, and reaching and impacting 3.8 million farmers, among other beneficiaries. The Equity Afya franchise has continued to grow and has now expanded into the Democratic Republic of the Congo, where we are looking at establishing 30 clinics. As at 31st December 2023, Equity Afya Medical Center Network stood at 98 clinics and had attended to 2.1 million patients cumulatively. Our concerted endeavors have not gone unnoticed. The group's business model has received validation from various rating agencies and earned recognition at local, regional, and global levels. The bank was ranked second in the world's strongest and most valuable banking brands 2024 by Brand Finance, with a brand strength rating of AAA+. This is a testament that our purpose of transforming lives, giving dignity, and expanding opportunities for wealth creation is continuing to prove to be relevant to our customers, industry, and stakeholders. We remain steadfast in our commitment to enhancing governance standards, acknowledging the dynamic nature of governance amidst the continued growth and evolution of our group. This entails vigilance in response to both internal dynamics and external regulatory landscapes. Furthermore, we have reinforced the composition of subsidiary boards with strategic appointments, enriching our governance ecosystem with diverse skill sets and expertise, thereby ensuring robust oversight and strategic direction. A key highlight of the board was the acquisition of Compagnie Générale de Banque, also known as Cogebanque, in Rwanda following regulatory and corporate approvals that were completed in 2023. The group acquired 99.261% of the issued share capital of Cogebanque, which was the furthest largest bank in Rwanda, by assets operating through 28 branches. This strategic acquisition was in line with our geographic expansion strategy that includes identifying synergistic entities for acquisition. Cogebanque's acquisition and the subsequent amalgamation with the group's existing banking business positioned Equity Bank as the second largest bank in Rwanda after the merger. Looking ahead, the board of directors at Equity Group will devote its attention primarily to overseeing the implementation of the Africa Recovery and Resilience Plan. The Africa Recovery and Resilience Plan is a strategic initiative designed by us to drive the socio-economic transformation of Africa, particularly in the wake of a global pandemic that underscored the need for resilience and recovery. This primary focus on the Africa Recovery and Resilience Plan is complemented by traditional areas of board oversight. Key facets of our operation, such as risk management, regulatory compliance, performance assessments, and reward system, will continue to be critical considerations. Likewise, novel spheres of significance such as sustainability practices and information technology demand the board's unwavering vigilance and oversight. Each of these areas brings distinct challenges and opportunities, requiring ongoing analysis, prudent judgment, and decisive action. Sustainability continues to be deeply ingrained in every facet of our operations. We continue to craft and execute strategies aimed at minimizing our environmental impact, preserve resources, and bolster business resilience. As we progress on our trajectory, we hold firm to the conviction that robust, adaptive, and accountable governance is paramount in realizing our strategic objectives while fostering enduring value for our diverse stakeholders. The board is continually inspired by the unwavering dedication and passion exhibited by the group's leadership. Through their consistent courage and vision, our leadership has steered the group with remarkable resilience. They serve as the embodiment of our mission, shaping our organizational culture and charting a course for future growth with strategic foresight and unwavering judgment. Our customers form the lifeblood of our organization. They are at the heart of everything we do, from strategy formulation to product development and service delivery. We also recognize our other stakeholders, including investors, strategic partners, regulatory bodies, and the larger communities within which we operate. Their roles, influences, and interactions fundamentally shape our organization's direction, making them intrinsic to our operations, strategic decisions, and success. The board views this display of collaboration not merely as an asset, but as a vital force imbued within the group's DNA. It is what gives us confidence in our ability to deliver on our promises, navigate uncertainties, and build the foundation upon which our future success will be built. Thank you all. Shareholders, I now invite the Group Managing Director and CEO of the company, Dr. James Mwangi, to introduce the management team and to brief the shareholders on the year under review and the future prospects of the company. Dr. James Mwangi.
Thank you very much, Chairman. Esteemed shareholders, investors, we are delighted to be with you this morning as we execute the annual general meeting. I've been invited by the chairman to introduce our management. Allow me, shareholders, to start by acknowledging the great support that the management team of Equity Group has delivered in achieving the year that was. At my office, I'm privileged to have two executive directors, and I want to introduce Mary Wamai and Sam Kirobe, the two executive directors who have stood with me. Shareholders, allow me to introduce the others as we move on. Ladies and gentlemen, welcome to our 20th AGM. The Group Executive Management Team is highlighted on page 33 to 34 of the Integrated Annual Report. Shareholders, my report to you for the year ended 31st December 2023 is contained in the Integrated Report on pages 26 to 28. I shall take the report as read. The Integrated Report remains accessible on the company's website. And now, shareholders, I'll proceed with my presentation. Allow me to start with 2023 performance. When we look at the balance sheet, and the chairman has ably communicated to you the operating environment, we see the balance sheet total assets growing by 26% and strong resilience in mobilization of deposits by 29%, and our loan book growing at 26%. Shareholders, this reflects the resilience that this group has been able to build over time, and hence able to ride the challenges the chairman ably talked about of inflation, exchange rate, high interest rates, and generally operating within a VUCA environment. I wish to point that the group remains resilient, founded on three strong buffers. One, our strong capital base of 218 billion, which grew by 20%. Our strong liquidity reflected by the cash and cash equivalent and government securities, which grew at an average of 26%. And of course, the agility of the balance sheet with a liquidity of nearly 54%. Liquidity continues to be a big buffer during hard times, and the back of challenges is backstopped by your shareholders' funds that continues to give us strength. While the balance sheet reflected great resilience, the marketplace was too volatile. We were operating in a VUCA environment. So the same resilience is not reflected in the profit and loss, because this reflects the activities of our customers. We are an aggregation in the marketplace of all the transactions of the individual customers. So while our interest income grew at 30%, our interest expense grew even much faster at 53%, and we see the implication of high interest rates destabilizing our top line. Our non-funded income continued to show strength and resilience as we moved to support our clients with non-funded assets like LCs, guarantees, and we strengthen our treasury activities in trading. However, given the challenging environment, we saw our loan loss provisions growing by a whopping 139%, while our staff costs, because of inflation, grew by 128%. And our other operating expenses, because of the imported component of the services, particularly IT services, services by global service providers, reflected the volatility in our exchange rate and high inflation, and grew by 39%, making our total cost to grow at 52% as compared to 25% of total income. And that had significant impact, lowering the growth rate of our profit before tax by 13% and our profit after tax by 5%, the first year in many years to record a declining profitability, reflecting once again the operating environment, the volatility, but as we can see, it's to a great extent NPL position, inflation, volatility in exchange rate, the impact it had on cost, and of course the top line. This has given us a focus to see how we could be able to continue to strengthen this. And we have hedged against the significant impact by focusing on our diversification, and the regional or subsidiaries reflected the impact that they could have. And we have seen significant reduction on Equity Bank. It now only Kenya, it only now contributes 50% of our total deposits, 51% of our loans, and 56% of our profit after tax, showing the significance that our regional subsidiaries, led by Equity BCDC in DRC, which contributed 32% of deposits, 32% of loans, and 25% of the profit. And we see the significance of continuing with this strategy and deepening it also from a product lead. So when we look at the subsidiaries, we now have become strategic players in all the markets that we operate in. We see Kenya, we are playing in position 2. DRC, we are in position 2. Rwanda, we are playing in position 2. Tied that is to the acquisition that the chairman talked about of Koje Bank. And we have improved significantly our position in Uganda, where we are now playing at position 5, and position 4 in South Sudan, and continuing to improve from position 14 in Tanzania to position 13. So we have become a systemic regional financial service providers. Shareholders, as we considered the possibility of paying a dividend, we were cognizant of the challenges that we have talked about, a very volatile operating environment, a deteriorating loan book, and this helped us to consider the dividend payout. We retained the dividend payout, recommended dividend payout similar to the previous year, that played out to a payout ratio of 36% compared to 33.6% the previous year. A significant improvement. But earnings per share had declined from 11.9 to 11.2. So we compensated by increasing the payout ratio and retaining the dividend of 4 shillings per share, giving us 15.1 billion shillings as dividend payout, again matching our record payout in the history of the company. We are grateful that the retained 64% will support in funding the growth we have seen in our subsidiaries, and will continue to provide the capital buffer that is required and necessary during volatile times. We recognize that regulators are constantly increasing. We have seen in Uganda, the capital requirements have been doubled. And in Kenya, the capital requirement has been increased tenfold. But shareholders, I'm happy to report to you, given our balanced dividend payout, we have been able to meet the capital requirement even with the tenfold increase that has been proposed in this year's legal framework. Shareholders, turning to the employee share ownership scheme that you approved last year. This year we are coming with the employee share ownership scheme, or ESOP as we further call it, bringing the trust and the rules that will govern the allocation of the shares. But shareholders, we have started seeing the significant impact that ESOP will have in this organization. It has helped us to attract new talent. And as the chairman was introducing the team accompanying him this annual general meeting, Moses Nyambanda, former managing director of Pricewaterhouse, Rwanda, and with oversight for a significant portion of East Africa, has joined the group. We believe this is significantly contributed by the belief that we have a long-term reward system for our staff. We've also got Natasha Ansel joining us as our group commercial director. And Ansel brings significant experience, having worked with the Citibank for 28 years, culminating as a managing director of Citibank Vietnam, and prior to that as managing director of Citibank in Ukraine. And that experience will help us to strengthen our internal control, our operating environment, while at the same time strengthening our commercial outlook. Beth Kithinji was previously the advisor to the Central Bank Governor of Kenya and head of internal audit and risk management at the Central Bank of Kenya, has joined us as head of our internal audit department. Again, we can see the promise of a share ownership scheme, the alignment of staff to the long-term interest of the shareholders has helped us. Gertrude Karubanga, who's sitting with the chairman at the high table, has joined us as the chief legal officer, joining us from Uganda, where she was the commercial partner in the leading commercial legal firm, DLA and Piper in Uganda. So we see Lene Karonji joining us from JP Morgan to come and head our product house. Hughes Efoke joining us from MoneyGram to come and head our payments. And when you look at this brings the global skills that will enable us now to match the global brand that we have built with global operational capability, global commercial capability, and harmonize what happens within the organization. We've also been joined by Amrit Gayan to manage our group services, Dr. Patrick Gatonga to manage our health program, Wafura to help our internal control. And when you look at the team, they bring enormous experience. So even before putting in place the employee share ownership program, we see the thought by the shareholders to approve it has created an enabling environment. We've also been able to retain very key staff, and we believe that the retention program, and we have people like Thelma Akananga, who is our cyber risk officer, and who this year was ranked as the highest rated cyber risk officer in the world. We have Emmanuel Makde leading our credit origination, Sam Kitwekere leading our credit risk and underwriting, Michael Kofi from Ghana leading our systems, Brent Malhai. So we are retaining the talent that helped to build this bank. Joy Benedicto, who has helped us to build the global brand that Equity has become. Ajera Okidia, who has helped us to start on a very high footing our insurance business. David Sengawa, who has helped to put this talent together. David Gata, who has helped us to maintain our reporting. And Christine Brown, who has helped us to manage our distressed book, demonstrates the power ESOP would have. And we're also glad that young leaders who have grown within the organization, led by Samuel Kerobe, our first equity group leaders scholar, Lydia Dilango, our tax expert, Mary Intele, financial reporting, John Juguna, capital allocation, John Wamai, all have remained inspired by this long-term retention program. And so we want to take this opportunity to thank the board for consideration of setting ESOP, and now request to extend the same consideration as they approve our trust deed and the rules of the trust, so that we can operationalize the ESOP, so that we can continue to attract, retain, inspire, and develop our human capital. Shareholders, we recognize that there is no organization that can be better than its staff and management. And so the better the quality of our management, the better we become. Equity has grown, and as chairman expounded, is now ranked the most valuable brand in East and Central Africa, and Africa's strongest financial brand, and the world's second strongest financial brand. Our efforts to diversify through regional expansion and deepening our offering have led us to have a very wide structure spanning over banking, insurance, technology, foundation, health, and real estate, because of our huge asset portfolio in DRC. This has prompted us to rethink how we would be reorganized, and we, shareholders, we are putting before you a proposal of reorganizing ourselves so that we can have 4 holding companies: the banking holding company, the insurance holding company, the technology holding company, that you have all, which all you have approved. But now we are seeking to build a ultimate holding company that becomes the investor in those holding groups, and we can have the holding group of each of the 4 companies groups having very specialized skills and focus, also that we continue to strengthen the group. The structure of the group essentially, as we have said, will be broader. It will embody the governance, it will embody the oversight, and what we'll be we asking is the setting up of the Equity Group Holding PLC and separating it from Equity Banking Group, which has been acting as the holding company, so that it's not the banking holding group that exercise oversight over insurance or technology, but we have. Shareholders, we can't thank you enough for allowing us to present last year our intention to acquire Koja Bank, a transaction that we are bringing forward to you for ratification. The acquisition of Koje Bank has given us significant market share, increasing our market share in Rwanda from 12% to 18%, making us a systemic player in that market, and giving us a chance of now competing for the top position and enabling us to deploy capital to grow the business. This essentially makes Rwanda to compete with Kenya and DRC being in the top two banks in the market, bringing efficiency and scaling the great cost-income ratio that we enjoy in Rwanda of 36%, over 1.5 times the balance sheet that we used to hold. Shareholders and investors, we talked at length about the brand and take a lot of pride on the brand that we have been built. This brand was built on the social impact. When we built the social impact investment engine that eventually became Equity Group Foundation. Equity Group Foundation has really anchored our effort in de-risking, capacitating, and enabling customers to grow within the bank. And our growth is attributed and directly related to the growth of our customers. This role that Equity Group Foundation has played, we have appreciated how it has positioned us, a soft brand, a brand globally recognized, and we have decided as management to enhance that brand by extending beyond social to sustainability, such that we look at governance, we look at social, we look at economic, and the sustainability of the entire operating environment. So we are rebranding Equity Group Foundation from just being a social engine, but a sustainability engine, and strengthening it significantly. The impact of Equity Group Foundation makes us proud to be associated with that. It gives the Equity Group a human heart, a soul that makes us associate with it as human beings, and it continues to inspire staff to become better people. The impact continues to grow. We have now scaled up health, and I'm glad to maybe inform you shareholders that we now have 118 hospitals at level 3 and level 4, and those hospitals are now, month of May, were able to attend to over 101,000 patients in just one single month. Ideally, we went to health because we realized 40% of our default rate only occurs when a customer or a household gets health incidents, and then the cash flow of the household is diverted to attend to the needs of a needy or a sick household member. This Equity Afia, the network, the franchise that we have provided, combining with our health insurance company, will significantly reduce this, and we are looking at better days ahead. Shareholders, we recognize that this performance reflects the past, but you invest for the prospects of the future. When we look at the future, we are confident that better days are ahead of us. We are now a systemic bank in the entire East African region, an East African region that has emerged to be the fastest growing region in the world. So our outlook is positive. Despite the challenging microeconomic environment, we feel that will be countered by the strength and momentum of growth in the region, and wish to assure you that better outcomes. We have been able to attract and retain highly talented human capital, and we believe this is a human resource that has the capability to confront the challenges. They are highly experienced and have seen through the cycles in the financial sector, and we believe will help us. Beyond the region becoming the fastest growing region, we believe the underlying factors like available arable land, the rich wealth DRC holds of strategic green minerals, the infrastructure development in the region, the democratization that we have seen in the region, the resilience and recovery that Tanzania and Rwanda, which are among the top 10 fastest growing countries in the world, provides us with an opportunity to continue to deliver high performance, high return, and high wealth creation for you, our shareholders. So I want to leave you with the trust and confidence that the future will continue to look better than the past that we have had together, a past that we are proud of when we recognize that 31 years ago we were number 66 out of 66, the smallest financial service provider in Kenya, and we now have become a systemic financial group in Kenya, and we are no longer a Kenyan group. We are now in 6 countries, and out of those 6 countries, in 3 of the countries, we are in the top 2 largest financial service providers. That gives us confidence that the experience that we have gathered, the exposure that the 32 years have given us, we have learned the lessons and have developed the insights that will help us manage volatile environments, challenging environment, to continue to give you a great return. We deeply appreciate the support you have continued to give, the understanding that you have continued to offer us, the guidance as shareholders you have continued to give us, and we want to express our gratitude to you and give you our commitment to remain steadfast for the purpose that we are called to of changing lives, empowering people, and expanding their opportunities for wealth creation. I thank you. Chairman, I'm grateful for the opportunity. Thank you.
Thank you, Dr. Mwangi. Shareholders, the director's report was also circulated with the integrated report, and it is contained on pages 103 to 104. With your permission, I shall take the report as read. I now call upon Ms. Bernice Kemashia of PwC, our external auditors, to read the external auditor's opinion, which is part of the external auditor's report appearing on pages 109 to 122 of the integrated annual report for 2023. Ms. Kemashia.
In relation to our audit, these include the responsibilities of the auditors and the directors in relation to the financial statements, key audit matters, as well as our report on the director's remuneration statement. Shareholders, I will request that the report be taken as read, other than our opinion, which I will proceed to read. It reads that we have audited the accompanying financial statements of Equity Group Holdings PLC and its subsidiaries on pages 123 to 242, which comprise the consolidated statement of financial position as at 31st of December 2023, and the consolidated statements of profit or loss, other comprehensive income, changes in equity, and cash flows for the year then ended, together with the company statement of financial position as at 31st of December 2023, and the company statements of profit or loss, other comprehensive income, changes in equity, and cash flows for the year then ended, and the notes to the financial statements comprising material accounting policies and other explanatory information. In our opinion, the financial statements give a true and fair view of the financial position of the group and the company as at 31st of December 2023, and of their financial performance and cash flows for the year then ended,
in accordance with IFRS accounting standards and the requirements of the Companies Act 2015.